Mr. Karwa, good morning and thanks a lot for joining us. It's not been a good start to the markets this year. The Nifty is now down about 10% from the highs that we saw in October. What's the sense you're getting about which way the markets could head, given the headwinds that we have upon us?
Good morning and thank you for inviting me. Yes, so I think market is playing as per expectations. If you look at it, that we have been talking about that 2022 is expected to be volatile, and the expectation that Fed will look at tightening and interest rates will also harden. I think all those were kind of expected. It's a different story that maybe the pace of inflation has been much aggressive than what it was expected, and that is the fear, and also the global geopolitical crisis is playing into it. But having said that, I think as far as domestic investors are concerned, we are seeing very good strong domestic fundamentals as we see the GST collections and even the fiscal and the monetary policy is all growth oriented. And I think retail investors or domestic India is realizing that if you see the robust inflows which are coming into the mutual funds. As far as SPI selling is concerned, I think they have their own challenges, as we just alluded. And if the selling is for global tightening and global liquidity, I don't think so we should take too much of cognizance. And this kind of sell-off could be opportunities for investors, domestic investors with a long-term outlook to be looking to invest in the markets.
Well, morning, Krishna. Thanks so much for joining in. We are seeing a sharp downtick trade, a kickstart trade, but the Nifty Bank is the one that's getting a harder hit. That's clearly been the sector that's been outperforming. How do you view the banks and financial space? And would you look to get in on any kind of dips?
So, Nigel, as far as banking stocks are concerned, I think the top 2-3 stocks in the sector are heavily overowned by the FPIs, and whenever there is going to be any aggressive FPI selling, they would be under pressure. But having said that, from a one-year perspective, if you look at the private sector banks have underperformed and the public sector banks have outperformed. If you look at the credit outlook, the growth seems to be much stronger. Credit costs, etc., are also behind, and most bank balance sheets are also cleaned up.
To you in a bit. We're having some issue with that video, but just take a look at the markets now. It's sliding further, 450 points gone on the Nifty. And we need to put this into perspective with what's happening globally as well. We're not alone in this sell-off. Most global markets, including markets like Hong Kong, etc., are down about 400 points. So it's geopolitical tensions that are weighing heavy on markets, including India. 450 points gone on the Nifty now. The mid-cap index is down almost 900 points, and it is a steep sell-off across most of these vulnerable pockets, whether it's infrastructure, real estate, sugar, NBFCs, all of them down about 4-5%. Krishna Kumar Karwa is back with us. Mr. Karwa, you were telling us about how to approach these markets now after a steep fall. Your thoughts?
Yeah, as I said that the domestic fundamentals are very strong, and as also alluded by the strong GST numbers and the fiscal monetary policies all being aligned for robust growth. Nifty earnings itself are expected to grow by 20%. So these kind of sharp corrections are opportunities for domestic investors to be looking to invest in the capital markets. The global sell-off, there are global reasons for that, and that should not be the reason for domestic investors to be not investing into the markets. So we continue to be positive. Yes, markets will be volatile, and you should be looking for muted or rather reasonable returns from a 12 to 18 month perspective. In fact, equity investing is not about quarter to quarter returns. I think we make returns maybe in a few months for the full year. So investors should not be only focused on what kind of returns that they should be making in the next 1 year.
Well, hold that thought, Krishna. Just take a look at the Nifty. We went down to around 16,916 odd. From there, we've seen a quick 100-point bounce from the low point of the day. And I think it makes sense to pull up the Nifty IT index because that one's seen a bit of a bounce from the low point of the day. Stocks like Wipro, you have Infosys, TechM, they've seen a bit of a bounce from the day's low. And that's why, in fact, we're seeing a bit of a fight back. Pull up the intraday chart of Wipro. Well, that stock was down close to around 4% odd. Now it's down 1.5%. Mahindra and Mahindra as well. Sonia had mentioned the stock was down 7% odd. That's cut its losses as well. So there is a bit of a fight back. You got a reference point actually in the first few minutes itself. 16,916. That's the level you should be looking at because that's the low of the day so far. Well, Krishna, one pocket of stocks which has been very boring, so to call it, has been the erstwhile blue chips. You have Hindustan Unilever, Nestle. A lot of money has been made in these mid-cap names, but these were ignored. Now, given that we could get into a period of some kind of volatility, would you look at allocation to some of these stocks?
See, most of the consumer names in terms of valuations, they are expensive for the kind of growth that they are showing. And so that's the reason why, if you have seen on the last 12 months, from a 12 months perspective, they have not delivered exactly good returns. Also, if you look at the way inflation has impacted them in terms of their margins, so that is also a challenge. So going forward also, I think if there is going to be a volatility in the market and if interest rates are rising, then possibly value stocks will possibly be much more into play than so-called expensive growth stocks. So my sense is that even from a next 12 months perspective, some of these consumer names should continue to languish more before investor interest comes in. Some kind of price correction, more than price correction, I think time correction would be the what will happen over there.
Okay, all right. So expect more time correction rather than price correction. I think that's something that the street wouldn't mind, given that we've had such a big rally. Time correction perhaps could be healthy for the market as well, right? Now the market is stabilizing a bit. So the Nifty is back above the 17,000 mark, 17,013. It's very volatile, though, you have to say. But the low that we hit was 16,916. And as you can see, there's a little bit of a bump there, back up. So stabilizing around that 17,000 pivot. Krishna, what do you do with IT, both large and mid-cap IT? I was doing a show on Friday with a couple of mid-cap IT specialists, and they said that there is a big boom coming in the mid-cap IT space because attrition was a huge problem earlier, but now there's large-scale hiring and all the supply-side constraints are going to be ironed out, post which there is a huge cloud adoption as well that's taking place. After a 15-20% correction that many of these stocks have seen, does it make sense to buy now? Or do you have a different view?
So as far as the business opportunities for most IT companies are concerned, there is no doubt about it. They are enjoying massive tailwinds in their chosen line of activities within the IT space. So there is no doubt on that front. And yes, there have been challenges as far as employee costs and the huge attrition level that many of these companies are facing. But yeah, hiring is very aggressive, and in the next 6 to 12 months, maybe they will also have sufficient bench strength. And price corrections of almost 20-25% from the peak for most of the IT companies offers an opportunity for investors to start nibbling again into this sector. So yeah, going forward also, we believe that there should be decent returns that IT companies should be able to deliver to investors. They have robust businesses, and the cash flow conversion is also very strong, and evaluations which were elevated and maybe discounting FY24, FY25 maybe a month ago. But now with the corrections, I think maybe they are getting into a territory where investors could start to nibble slowly and steadily.
Krishna, where you're talking about value stocks. Where do you find these? I mean, will you look at the PSU basket, the Coal Indias, ONGCs of the world? Does ITC fit the bill?
See, I think as far as PSUs are concerned, you'll have to differentiate within the PSU pack. So where are the tailwinds today? The tailwinds are in the banking and the financial sector. So many of the banks in the PSU sector, they seem to be enjoying now tailwinds. Valuations are reasonable. Most of them have reasonable capital adequacy. So I think that is one space where you would see a lot of investor interest coming in. And the beauty is that they are under-owned. You do not have too many institutions, whether it is local or global, who own these banks. So whenever there are tailwinds, then the tier 2, tier 3 banks in any sector, tier 2, tier 3 stocks in any sector will do well. So I would be very positive on the PSU banks. As far as fossil fuels and refiners, those kind of companies are concerned, I think, yes, they are currently doing well. But whether there will be follow-up buying from investors, I doubt So my judgment is that the returns in those kind of PSU stocks may not be as strong.
All right, we leave it at that. Mr. Karwa, thanks a lot for joining us. These are difficult times for the bulls. But in any case, we've had a rally of around 1.5 years. So some correction perhaps is healthy for the market. Well, for now,